Testing. Testing.
1, 2, 1, 2.
Testing.
All right, if everyone could take their seat, we're going to get started in about 1 minute.
I think they turn his on first and then they turn theirs on.
I heard you. I heard you.
Hello?
That's an impressive reaction. If only I had half that luck with my kids at home, my household would be a lot more quiet. But anyways, as a way of introduction, my name is Greg Leonberger. I'm the Director of Research at Marquette. I may look familiar. In fact, hopefully I do look familiar to some of those of you who have come here before. Brian made the point earlier, his suit still fits. My suit still fits too, but I hope I look the same as well. So for those of you who are new, welcome. We hope this is going to be a good use of your day. So I brought some friends along with me today. I have 4 members of the research team who are going to help me with this conversation. I have Jessica Naviscus, Associate Director on the team, David Hernandez, Associate Director on the team, Frank Valley, Senior Research Analyst. Last but certainly not least, Mr. Evan Frazier is a Senior Research Analyst. Now, before we get into this, I titled the talk as An Investor's Roadmap for 2022 and Beyond. Our previous speaker mentioned that some generations ask the question why more frequently than others. I can assure you from having gone to a lot of client meetings this year that everyone is asking why about the markets this year. But before getting into it, I want to ask you all the question. I promise you this is the only time I'll ask for audience participation, but think back to your committee meetings, your planning back in December and January, and trying to figure out what to expect out of the capital markets. Certainly there was an environment that inflation was high, probably going to creep a little higher. The expectation was rates would move a little bit higher, and boy, equities have been really good for 3 years, and can that continue forever? But raise your hand if you had us in bear market territory by middle of September. Then your core bonds, which are going to save you from volatility, are down 12%. Interest rates 2 to 3 times higher. We have really high inflation, runaway, almost runaway inflation, maybe you could argue. We're in a recession, maybe we're not in a recession. We will revisit that question a little bit later on. But it's been a really difficult year. And yeah, I think we all expected some volatility, but this has really been unprecedented. So what we're going to do is we're going to look backwards and look forward. We titled this a roadmap. So we want to look backwards and see what's gotten us here, right? Why are we here? What has driven markets to this point? What has driven economic growth to the point where it is today? Or perhaps more accurately, what are the headwinds for economic growth that we've seen this year? So that's looking backward. Then we're going to stop and look forward. A lot of different paths that we can see for capital markets, for our economies. What are some of those paths? What are some of the drivers? What do we think are most important to share with you, our clients? Then we're going to finish with a couple of bigger picture, longer term portfolio guidance. I'll call them reminders. I wouldn't say that any of these are going to be eureka moments for any of us here in the room, but I think they're good reminders, particularly as we sit here in an environment where rates are high, they're going higher, equity market volatility, I hate to tell you, it's not going away at the end of the year. That's going to continue as well. So again, some reminders for all of our clients. To kick it off, and excuse the cliche maybe, but to set the table, you're going to see an alphabet soup of headlines and terms this year, mostly of the negative variety. I think we're all tired of seeing them on MSNBC, CNBC, Wall Street Journal, Financial Times, whatever publication or website you read. Inflation, recession, market volatility, supply chain, Russia, Ukraine, the list goes on and on and on. What we're really going to do is connect these headlines and connect these trends, not only with what has happened, but what we think the future holds as well. So all that said, what we'd like to do, though, is start by talking big picture. Let's talk about the economy first. We think that's really a healthy perspective and really the backdrop for all financial markets. And Jess, I'm going to bring you in here. And really, if you think about 2022 and the economy, there's been a lot of, like we said, negative headlines, a lot of headwinds. Maybe touch on some of the ones that you think are really the most important, and then also what the Federal Reserve's done to mitigate some of them.
And I have decided to skip my soup joke this morning, so you're all spared for now. As you saw in the headlines, there is a lot going on at the macro level this year. A lot of moving pieces, a lot of uncertainty, and those factors are having a lot of influence over markets. A lot of that starts with inflation. We got the latest CPI reading last week. It was worse than expected, catalyzed this most recent sell-off, and really led to a broader repricing of risk in markets. The numbers: August headline CPI of 8.3% year over year. That was down from 8.5% in July and off the peak of 9.1% in June. But month over month inflation reaccelerated and core inflation reaccelerated, and that tends to be stickier. The biggest contributor to the reacceleration was shelter, housing, and that is a secular issue. We have underbuilt housing in this country. There is an affordability crisis. And as the Fed raises rates to combat higher inflation, that feeds back into a higher cost of living. So I think last week was a bit of a turning point in markets, realizing this is probably not going to be an easy short-term fix, and we are probably looking at even higher interest rates from the Fed. The Fed's primary tool for fighting higher inflation is higher rates. And given what we've seen out of CPI this year, we've also seen a sharp move higher in rates. The Fed, at least in hindsight, was late in responding to higher inflation, so we didn't get that first rate increase until March of this year. And over the last 6 months or so, we have seen rates go from about 0% to 3%, which is a big move. And they are almost certainly going higher from here. So the last Fed meeting was Wednesday, 2 days ago. Chairman Powell was talking about first taking rates into restrictive levels, meaning at 3%, we are just entering restrictive territory, and keeping them there until the labor market cools and we see signs that inflation is headed back to 2%. Restrictive levels mean just that, restricting growth. It is necessary to cool inflation, but also presents risks for the economy at the macro level and at the micro level for companies and their earnings outlooks.
So Fed policy has definitely impacted the Treasury curve. We came into the year with a fairly normal looking Treasury curve, albeit at a much lower level than it is today. Throughout the year, inflation has pushed the Treasury curve higher, but the front end of the curve has been particularly impacted due to policy moves. The front end of the curve is a lot more impacted by what the Fed does, and so raising rates has really impacted the front end and pushed it up to a flat or even inverted level. Some people view an inverted Treasury curve to be a forward-looking indicator of a pending recession. So the primary driver of fixed income returns are rates. And so with rates up, it's no surprise that fixed income returns are down. Through the first half of, through August of this year, we're down 10.75% on the Barclays Agg, which is by far and away the worst on record. But it hasn't just been a rate story this year. So not only have we had rates be a negative return, we've had a double whammy because spreads have also widened this year. When you think about the investment grade market, investment grade credit spreads are 43 basis points wider. That's led to a negative 222 basis point return, excess return relative to treasuries. High yield has a similar story. High yield spreads are almost 200 basis points wider, and that's led to a negative 5% excess return to treasuries.
And when you look at fixed income, none of these capital markets, none of these markets operate in a vacuum. There's a pretty high degree of correlation of what you see in the below investment grade space. So running forward with the high yield example here, you've seen spreads gap out, right? Which is an expression that there's more risk in the market. And that's really reflective of what you've seen in the equity market as well. So Jessica, back to you. Talk a little bit more about, I'm not sure if unprecedented would be the right word, but certainly it's a more volatile year than what we've seen in the more recent past.
Yeah, equities have had an extremely volatile year, and that really goes back to the level of macro uncertainty in markets. It's not just that things are bad. We have a playbook for bad. Managers have a playbook for bad. It's that we don't know how bad things are going to get, and we don't know when. And it's been that uncertainty and that sentiment that has driven markets more so than company fundamentals. And that is a tough environment for managers to navigate. So in typical risk-off fashion, we've seen them pull back from markets, take risk off the table. We've been tracking that this year in hedge fund exposure levels, in mutual fund cash levels, and when you withdraw liquidity from a market, it tends to become even more volatile. You're trading in a vacuum, you're prone to overreaction, prone to fits and starts, and that is what we've seen play out in the US over the last few months, that bear market rally, the sharp reversal, but that's mostly at a high level. Evan, can you walk us through some of the details and what is driving markets under the surface?
I certainly can, yes. So as you are all no doubt aware, it's been a difficult last few months for equity markets in general. We'll start on the domestic side. So the S&P 500, which is sort of the broadest measure of domestic large cap equities, is down about 16% through the end of last month on a year-to-date basis, and September hasn't exactly been a banner month for stocks either. So what's been driving that? Well, from a sector perspective, again, as you might expect, a lot of those growth-oriented spaces within the U.S. equity market, so think information technology, consumer discretionary, communication services, all of those spaces are down more than 20% amid this backdrop of rising interest rates that Frank and Jessica discussed, as well as maybe some growth concerns about some of the companies in that space. Two bright spots on a sector perspective were the utility space, which is up on a year-to-date basis. That's more of a defensive kind of bond proxy sector that we would expect to do well during periods of market volatility. And then the energy space, which is up about 45% on a year-to-date basis through the end of last month. And Ibrahim and Lindsay will talk a little bit more about that in a subsequent flash talk. but certainly a strong returning sector this year. Another way to think about what's been driving equity markets in recent time is to examine the extent to which performance is being driven by either earnings growth or changes in company fundamentals versus multiple expansion. Those are the two primary drivers of performance at the sector and index level. So if we rewind the clock a little bit to 2019 and 2020, you'll recall that the S&P and really a lot of domestic indices exhibited some pretty strong returns, so upwards of 18% in both of those calendar years. Pretty much all of that performance was being driven by multiple expansion, so it really didn't have anything to do with the changes in underlying company fundamentals. Indeed, 2020, you'll recall, COVID came onto the scene, company fundamentals were really hit hard, earnings growth took a major hit, but performance for the index was still up because people were piling into stocks, right? Multiples were so low, there was no alternative to equities. Fast forward to 2021, you had a similar story on the performance side, so the S&P notched a very strong return that year, but that was primarily driven by earnings growth off the backs of those low COVID comps. The multiple on the index actually saw some re-rating, and that's what drove performance that year. Fast forward to this year, so what's been driving this poor return? Well, we actually haven't seen earnings growth or company fundamentals deteriorate that much this year. In fact, earnings growth for the index, the S&P, is still positive on a year-to-date basis through the end of last month, about 10%. But we have seen continued multiple compression. So the price-to-earnings ratio on the S&P has contracted about 20% on a year-to-date basis through the end of last month, and that's the thing that's been driving that poor return thus far. Now, maybe taking a step back and looking at the global equity landscape, I talked about poor performance on the U.S. side of things, but that poor year-to-date return on the U.S. side really hasn't put a major dent into the longer-term performance differential between domestic stocks and their non-U.S. counterparts. This has persisted for over a decade, and Greg, maybe I'll turn it back over to you to get some insight as to kind of why that's been the case.
Yeah, if you look at this chart here, the longer-term trend of U.S. versus non-U.S. outperformance averages about 7 years. Right now, we're more than a decade into the U.S. outperformance versus non-U.S. And for the last couple of years, if you looked at the relative valuations of non-U.S. versus U.S., every year in January we'd say, is this the year? Is this the year that non-U.S. is finally going to outperform and perhaps start a new cycle, normalizing that kind of more typical longer-term pattern? And actually, through the middle of February, we saw that. We saw non-U.S. outperforming U.S., but as we look backwards on what happened this year, there are a couple explanations for that trend, why that trend once again reversed and U.S. is now outperforming non-U.S. once again. So David, you want to give us a little color on that?
Yeah, in 2020 and 2021, U.S. equities benefited tremendously from the post-COVID rebound. The S&P 500 generated strong returns. That was in big help to large cap tech stocks that had a tremendous run over that time period. Headed into 2022, many so-called market experts, including one panel member who happens to be talking right now, we thought non-U.S. equities were set up for outperformance headed into this year. To give us a little bit of credit, we were right for the early part, and if we go to February 21st and look at performance as of that date, the MSCI EAFE index, which is a non-U.S. developed benchmark, was beating the S&P 500 by 4% year to date. The MSCI Emerging Markets Index was beating the S&P 500 by 9% year to date. Pretty good start. A couple of days later, Russia invades Ukraine, leading to a humanitarian crisis. And that event had a tremendous impact on financial markets. And that impact was especially great outside the United States. Jessica talked a little bit about inflation at the start of the year. So headed into 2022, inflation was high, but Russia's invasion of Ukraine exacerbated that. And that was especially felt in the United Kingdom as well as the Eurozone, which is heavily reliant on energy from Russia. And as we moved through the year, we started to see economic activity slow down, started to see consumers spend less as prices went up. And the risk of recession increased dramatically, especially in the Eurozone as well as the United Kingdom. So you had inflation, which hasn't peaked yet in Europe, and you have the probability of a recession. And those are two key reasons why non-US equities have underperformed US equities this year. And there's a third reason, and that reason is currency. So Frank, can you take a minute to talk about the US dollar and what that's done this year?
Sure. So this year, the dollar has really been king. The dollar index has been pushing on to new all-time highs. And why is that? Here in the US, the Fed has been very aggressive in fighting inflation by raising rates. Elsewhere around the world, central bankers have been a lot more patient. The ECB did not move until July of this year, and one extreme example would be Turkey. So Turkey has way worse inflation than we have here in the US, and they actually cut rates, and they've been cutting them all year as recently as this week.
So for US-based investors, currencies are a key component of investing in international stocks. If we think about how returns are calculated for investing in international stocks, you have whatever the stock is doing and you have whatever the currency is doing, okay? If we just isolate currency, we're just talking about currency here, and we can do that by looking at the MSCI EAFE Currency Index, that's for developed countries outside the United States. That index is down 12% through August. That's bigger than the losses we've seen on the stock side. In comparison, the MSCI Emerging Market Currency Index is down 5%. So you have -5 versus -12. The environment that we're in right now, the US is raising rates and economic activity throughout the globe is contracting. Those are typically two very, very bad things for emerging markets. We go back to 2013, remember the taper tantrum? Tough period for EM investors. So why are emerging currencies holding up better than developed market currencies? The answer to that question is rate hike cycles. If we go back to late 2020, emerging markets started raising rates post-COVID. Developed markets didn't start doing that until a year later, late 2021. The US didn't start raising rates until early 2022. The ECB, or European Central Bank, didn't start raising rates until July, as Frank mentioned. The BOJ, or the Bank of Japan, didn't start raising rates. Wait, they haven't started raising rates yet, so let me scratch that. But the point is that developed markets are earlier on in their rate hike cycle compared to emerging markets. And that's a key reason why EM currencies have held up better. Their interest rates started from a higher base when the US finally started raising rates. Now, thus far, we've talked about a lot of different macroeconomic topics. We've talked about inflation, recession, we've talked about currency, monetary policy. All of these things have had a major influence on asset class returns this year. Let's dive a little bit deeper and let's look at global equities. Evan, can you talk about how these macroeconomic factors have influenced style returns for global equities?
I certainly can, yes. Maybe we'll start on the growth versus value side. That's always a hot topic of discussion for folks like us. It should come as no surprise that we've been living through a very unique market environment over the last few years. There have been a lot of events that have taken place in recent time that have not only been aberrational in nature, but have also led to strong relative performance by either growth or value. So rewind the clock back to, say, 2016, right? The beginning of that year, you had the Brexit referendum in the United Kingdom, and then a few months later, you had the election of Donald Trump here in the United States. Both of those events, generally speaking, were good for value-oriented stocks. So more defensive value names did well at the beginning of that year, and then more cyclical, junkier, lower quality value stocks did well at the end. Fast forward a couple years later, so we were already living through this environment of very, very low interest rates. COVID came onto the scene in 2020. You had lockdowns, you had stay-at-home orders, you had rates that were already very low, dropped to pretty much zero. All of those things taken together are very, very conducive to outperformance of longer duration, higher octane, growth-oriented stocks. And indeed, that's what you saw. You saw very, very strong outperformance of growth in 2020. A couple months later, we had the COVID vaccine announcements. Those were good for cyclical value again. So we're ping-ponging back and forth between these swings of, okay, growth is doing really, really well, value is doing really, really well, very wide dispersions. This year, you've had a hawkish Fed, you've had high inflation. Neither of those things are good for either style on an absolute basis, but what you have seen are those, COVID winners, those longer duration growth assets really see their multiples take a pretty significant hit, and that has led to stronger performance for value on a relative basis thus far this year. And Dave, maybe I'll turn it back over to you to get a sense of style performance more broadly in recent time.
Yeah, there's other factors that we track in global equities, and I think there's an interesting story that has emerged in 2022, and that's centered around the quality factor. I want to take some time to define quality. That's probably a term that you hear a lot about in investing. So some common definitions or way to measure quality. I think there's three broad categories. The first is around a measure of balance sheet strength of a company. Typical metrics you'll see is debt to equity or other leverage ratios. Second broad way to define quality is through a profitability measure. Typical metrics are return on equity, return on assets, return on invested capital. A third common way to measure quality is around a stability measure. Some typical metrics: earning stability, cash flow stability, sales stability. Now, historically, quality as a factor has protected to the downside, has protected in down markets, right? And I think that makes sense. When the poo hits the fan, you would expect a high quality company to protect in that type of market. But that hasn't been the case in 2022. As a matter of fact, quality as a factor has been the second worst performing factor, right up there with growth. Investors have been uber focused on what the Fed is doing, what the ECB is doing, what the BOJ isn't doing, and what the latest reading of CPI has been, and less focused on fundamentals. And this has created a challenging environment for active managers, especially those that invest in volatile markets where quality historically is additive.
Frank used the term double whammy earlier to describe what's happening in the fixed income market, and that's really an applicable term for any actively managed U.S. equity product, or really any actively managed equity product across the world right now. You have all these macro headwinds which have driven markets down, and then on top of that, you have these whipsaws between value and growth, and then the quality underperformance has really made life difficult and even compounded the negative returns in some portfolios. Again, in the interest of kind of explaining what's happened to your portfolios from a macro perspective, as well as some of you who might be wondering why your active managers, even those with the quality bent, have underperformed some. So that's really the conclusion of the first half of looking backwards. Now we want to look forwards. And again, we're going to start with the economy. We do think that really is the most logical place to start, particularly given how the macro factors have really driven markets. And Jess, I think you have the hardest job of any of us right now to answer the question, are we in a recession? And I think there are different panel members up here who actually have different answers to that. I'm sure there are different opinions on the audience as well. And then if we're in a recession, or if we're going into a recession, how bad could it get? Or are there some mitigating factors which might make this a little more shallow than people expect?
Yeah, definitely my favorite question, Greg, but an important question as we think about the go forward is, will we go into recession? And I'm sure there are some folks in the audience, some folks on the panel that would say, well, we already are in recession. And that may be true. There actually is not one official, non-subjective definition of what a recession is. A lot of us think of it as 2 quarters of negative GDP. And in that case, yes, we are there. But the term technical recession has come up this year because it doesn't feel like your typical recession. Unemployment is still very low. The consumer is still pretty healthy despite all of the pressures from inflation, and consumer spending is still positive. Consumer spending makes up 70% of GDP. And looking back, it is very rare to go into official recession with positive consumer spending. So this is one of the things we're watching really closely on the US side, but these are global issues. Dave, what's your take on non-US markets?
Yeah, it's probably worse, especially for developed markets. So, I've talked a little bit about Europe, United Kingdom, and Eurozone. If you take developed markets as a basket and look at economic activity, since the start of the year, it's declined, and it's basically showing contraction, and that's as measured through the Purchasing Managers Index. In comparison, if you look at emerging markets, that economic activity remains positive. Now, emerging markets are comprised of 23 different countries. They're all in a different part of their economic cycle, a different part of the rate hike cycle. But broadly, if you put them collectively together, there the economic activity has been much better.
The challenge at this point is to then map these economic outlooks, which I would describe as a mixed bag at best, and what that means for capital markets. And I think the easiest connection to make is to look at rates. And we're most certainly in a different rate environment now than we were even at the beginning of the year. We have a consultant who might or might not be sitting back over there, who I will not name by name. I've been to countless meetings with them over the years. When his turn to give an outlook for fixed income, he would say, fixed income is math, the math is not good. Well, Frank, the math has changed a little bit, given what we've seen over the last 9 months, maybe even 12 months. Maybe take us through what that means from a rate perspective, a spread perspective, and overall outlook for the asset class.
Sure. So the returns for fixed income this year have not been good. However, it changes how things are going to go going forward. Somebody told me a cheesy dad joke that said, hey, fixed income has finally got its last name back, and that's income. We've got the ag now yielding over 4.25%, which is significantly better than it has been for an extended period of time. and the end of low-rate investing in fixed income might be coming to an end. So when I think about rates, we think rates are undoubtedly going up, but the good news is most of that's already been priced into the market, so there's no reason to alter your duration. Plus, you want to keep your duration because the duration in your portfolio is your hedge. That's what protects you. Should we see a recession, you'll see rates fall, and duration will be that anchor. On the spread side, valuations are actually fairly attractive from where they've been. Spreads have been historically tight for an extended period of time other than March 2020. Today, most spread sectors are trading at or through historic levels. However, I do want to express there should be some caution given with spreads, given that I do expect some volatility to continue over the coming months. And it really has to do with how well the Fed can execute a soft landing. The softer the landing, the less volatility we'll probably see. And finally, on the currency side, the strength of the dollar is expected to continue, really just because the Fed is going to continue to be aggressive in how they fight inflation. We have a lot better economy here in the U.S. Than we do see around the world, so they will continue to be aggressive relative to a lot of the other central banks.
Yeah. And I think this is maybe a good segue into the outlook for equity markets, at least in the near term. I talked earlier about the change in the price multiple, change in valuation for a lot of these indices being a key component of index performance over the long term. And I think before we get into the current valuation landscape, I think it's just important to highlight the relationship between yields, interest rates, and valuations, price multiples. And that is an inverse relationship. So as yields go up, multiples tend to go down, all else equal. So taking what Frank says into account and kind of prevailing sentiment about what the Fed will likely be doing, at least in the near term, those interest rate increases will likely continue to add pressure to price multiples going forward. And I talked about valuations coming in on the on the U.S. side, but it's not like things are super dirt cheap over here. So the S&P currently trades at about 17 times forward earnings. That's right around its 10-year average. And a lot of those growth-oriented spaces that have seen their multiples come in over the last few months, so information technology, again, consumer discretionary, they still trade above their long-term average from a forward price to earnings perspective. So when you take those two things in tandem, kind of the outlook for the Fed in the near term as well as the current valuation landscape, I think it's unlikely that we'll see returns being driven by multiple expansion on the US side, at least in the coming months. And I've been using price to earnings as sort of the metric that we've been focusing on from a valuation perspective. But if you look at other multiples for the S&P 500, like price to book, price to sales, price to cash flow, those are even more elevated relative to their long-term averages. So again, not dirt cheap over here on the US side. Dave, maybe I'll turn it over to you to get a sense of the valuation landscape for non-US securities.
Yeah. What Evan Frazier and the rest of big US equity don't want you to know is that international equities look better than US equities. They're cheaper than the S&P 500, and they're cheaper than their own history. We track 6 different valuation metrics, and 5 of those 6 metrics on the developed market side are trading at their top quartile of cheapness over the 15 to 20-year history. So there's an attractive valuation story there. If we key in on one of those valuation metrics, forward PE, those metrics are either at or below the March 2020 lows that were set during the COVID sell-off. So attractive valuations for non-US equities. We have to remember though that in most cases when assets are cheap, they're cheap for a reason. And I think we've outlined and given some reasons why they're cheap. So if we think about our short-term expectations for non-US equities, volatility, uncertainty, return perspective, it's probably likely we'll see some negative returns over the next 2 quarters. But if we lift our eyes up the horizon and look a little farther out, say 3 and 5 years, medium-term outlook, we're very optimistic about returns, both on an absolute basis as well as a relative basis for non-US equities, especially at these valuation levels. Now, there is a market that I think has a big impact on non-US equities, and that's China. And we could spend the entire symposium talking about China. There's a lot there. We're going to give it 1 slide in this section, okay? Interesting data point, I think, or comparison to look at is Chinese equities versus US equities. This is the performance between the two over the last 7 years. We all know that US equities have been an absolute powerhouse in portfolios, driving returns over the last 7+ years. What some of us might find surprising is that Chinese equities for a lot of that time period kept up really well with US equities. There were actually some time periods like 2017 where China was outperforming the US. That did start to change though in 2021, and if we look at the year-to-date return comparison as of August, we now have the largest performance gap between these two countries than we've had over the last 7 years. So what happened? I think there's 3 things we can attribute to that Chinese equity sell-off. The first is change in regulatory environment. In 2021, the Chinese government put out dozens and dozens of regulatory actions that were hit on several key industries within that market, and that really shifted investor sentiment. The second thing is the property sector. We've seen a slowdown in property sales. We've seen issues around defaults. We've seen citizens threaten to boycott mortgages. And the third thing is China's zero COVID policy. That has really put a cap on a post-COVID economic recovery, and through different parts of 2022, we've also seen economic contraction in that country as a result of zero COVID policy. Now, 2 of those 3 topics are still very relevant right now and will be very influential on returns the rest of the year, and that's the zero COVID policy and the property sector. The Chinese government's action or inaction around those things will have a heavy influence on returns. So if the government came in, instituted some stimulus, supported the property sector, investors would eat that information up and we'd probably see really strong returns. On the flip side, if the Chinese government didn't take any actions and we got negative news, we could see some negative returns there. So if we think about global equity markets, China's probably the one that has the widest range of possible outcomes over the next coming quarters. But if we look farther out, medium term, China, we think, is a investment universe that is rife with opportunity, especially for those that are looking for alpha generation. That's the outlook for non-US equities. What's it look like for US equities, Evan?
You want to talk about the asset class that's actually been beneficial to client portfolios again? I'd be happy to. Yeah, so I talked about the 2 primary drivers of index performance over the long term. We hit on multiple expansion or contraction. The other one was earnings growth or changes in company fundamentals. So where are those going over the coming quarters? Well, I think it's safe to say that earnings growth will likely be slowing for a lot of domestic stock indices in the coming months. So since 2021, the S&P grew earnings at about 5 to 5.5% on a quarter-over-quarter basis. That figure is likely to decrease to about 2 to 2.5% into 2023. And I think if we go into a more pronounced recession, deeper than the one that we're already in, Jessica, 2 consecutive quarters of negative GDP growth seems pretty non-subjective to me, but what do I know? I think it's safe to say that earnings growth might continue to slow and deteriorate if economic conditions sour. So that's the outlook for earnings growth over the coming quarters. I've been a little doom and gloomy, a little pessimistic during my allotted time here. I think I'll probably conclude my remarks with a note of optimism, perhaps. Always good to end on a lighter note. And that lighter note has to do with Fed rate hiking cycles. So as you might expect, when the Fed engages in quantitative tightening or hikes interest rates, equity market returns tend to be a little bit more muted. So going back to 1980, the early 1980s, during Fed rate hiking cycles, the S&P has averaged an annualized return of about 5.5%. And once we get the data from this current rate hike cycle, that number will likely see some significant deterioration. The good news is that once the Fed takes its foot off the proverbial parking brake and stops hiking rates, the S&P averages a 12-month return of about 17%. So again, we have to get there first. There might be some more pain and volatility along the way, but the night is darkest just before the dawn. I promise you the dawn is coming. Jessica, maybe turn it back over to you for some higher level thoughts.
Yeah, I think some additional historical context can be helpful. Drawdowns happen, they just do. And versus history this year has really not been all that remarkable. To borrow from Dr. Twangy's presentation, you are not special. We are still nowhere near where we were during the GFC or the dot-com crisis, and managers aren't even really baking that into their bear case models. But we also will probably not see the type of snapback that we did in early 2020 after the initial COVID sell-off, or the late 2018 drawdown when we got the Fed pivot in early January. Given where inflation is, that is less likely an option. So TBD what this chart looks like over the next 6 months or over the next 12 months. But what we do know is that overall and over time, equity markets go up. So I'm going to agree with you here. Don't have a heart attack.
For once, wow, oh my goodness.
There is light at the end of the tunnel. And from here, it's important to stay invested. So market volatility works in both directions, down, which we have gotten plenty of this year, but also up. And the best days in the market tend to follow the worst days. Timing the market is notoriously impossible, even for the best managers out there. And if you miss the best days because you cut your losses at the wrong time, you can dramatically alter your long-term return profile. If you had been invested over the last 30 years, compounding returns for 30 years, but missed just the 10 best days in the market, you would have cut your total return in half. So we know this market has been challenging and drawdowns are painful, but we cannot emphasize enough how important it is in markets like this to stay disciplined and stay the course.
So where does this leave all this? What does the short term look like? What does the long term look like? I think if you've been listening to each of the analysts, it's pretty clear that the next couple of quarters are continue to be difficult. There are more rate hikes coming. There's more volatility. None of these macro factors are going away overnight. We think that continues into 2023. But David said if you think about the next 3 to 5 years, it's an entirely different story. Rates are higher, right? What does that mean? To borrow your, quote, fixed income finally got its last name back, right? You're actually going to get paid to hold fixed income. Equities valuations have come down. For longer term, that tends to translate into superior returns. It's not going to be overnight. It'll be an evolution. Let me point your attention to the second point here. Changes versus expectations will drive market reactions. A lot of this is already priced into the market. The market knows that volatility will continue. We know more rate hikes are coming. But how the actual data compares to the expected data, that will have an influence on markets. At the end of the day, I think this is really just a 30-minute way of telling you, stay invested, rebalance, be disciplined. The phrase we like to use at investment committee is lean into the wind, make decisions that are difficult that no one else is doing. Over the long term, that pays off. Jessica just shared with you. If you try to time the market and miss the 10 best days, you've lost half the money you could have made. That's a staggering dollar amount. If you think about the missions of all your committees and all your plans, that's a lot of money that can be put to good use. So we're going to land there. What we have now is a break. Rather than take Q&A from the whole group, we will be up here. If you'd like to talk about anything that we mentioned today, please come. Anything's fair game. We're happy to talk about it. We'll take a break, and we're going to resume at 11 o'clock. Thank you.